Thanks for joining us today on Market Call. I'm Morello Fernandez. David Burrows with us on the show today. He's Chairman and Chief Investment Officer at Barometer Capital Management. He'll take your questions on North American large caps. And here's how to reach us. Call us toll free at 1-855-326-6266. You can email us your questions as well. Market call at bnnbloomberg.ca. David, thanks for joining us today.
Great to be here.
New intraday highs for the TSX today. What do you see driving investment at this point?
Look, it's been really the same themes all year long. If you look at the core sector leadership groups, it's been financials, industrials, and materials really driving the bus. And materials have been exceedingly strong. There has been, I think, continued hedging in portfolios against inflation, ultimately. Inflation is sticky. And while the Fed is now cutting rates, it probably increases the longer run chances for inflation. And you see that in the long-term Treasury bond. But really, the TSX is benefiting because our sector makeup in our market is a more inflation-oriented index.
You've noticed there isn't much of a correlation between stocks and sectors. So what does that tell you?
Well, look, the problem with market cap weighted sectors is they can become exceedingly overweight certain sectors. So when we look at the S&P is underperforming almost all global markets year to date because of a very growthy index. And some of the sectors that are really working are very small pieces of the S&P. So for instance, materials is like 3%, where in the TSX, it's a much larger piece in the teens. So, it's a market right now that is uncorrelated. It means there are haves and have-nots. It means as a portfolio manager, certainly for us, we are active managers. We have an opportunity to add value.
Okay, you mentioned that the S&P compared to other equities markets is not doing as well. Can you expand on that? What are the other markets you see stacking up right now compared to the S&P?
Sure. So from 2007 until 2024, the all-world index ex-US had almost no return. So whether you were looking at Europe, or whether you were looking at South America, or whether you're looking at Asia, Japan, 33 years of no return. But in the last 18 months, international equities are outperforming the US. And part of it has to do with the fact that 31 or 32% of the all-world index is financials, and financials have been very, very steady. Materials is a much larger piece of the global index. There are a lot of great industrial companies. And so what's happened is international investors wound up very focused in the US because it was the only game in town. And now their currencies are doing a little better and their markets are doing better. And we're just seeing some capital rotate back to international stocks.
All right, we're going to take a quick break. We will be back with David Burrows of Barometer Capital Management to take your questions on North American large caps. Here's how to reach us. We're back in a moment. Welcome back. David Burrows with us today to take your questions. We're going to start with an email from Allison. She says, I would like to ask David if he recommends Dollarama at these levels. David, I was just taking a look. A Dollarama hit a high of about 197 back in, I guess, August. It's now trading at about 178. Would you buy in at this level?
So, Dollarama is a stock that we owned for about 3 years. And we came out of earlier this year, partly because we are less bullish on the consumer. I think especially in Canada, real estate market's weak. People have been using their homes as an ATM, and consumer spending is a little bit weak. So we're a little bit careful there, even though it's a budget brand. Look, the stock technically has pulled back to the rising 200-day moving average. It is in a long-term uptrend. The relative price performance versus the market has been weakening. And that's one of the reasons that we stepped away. We're in a bull market, and we think you need 20 or 30 companies to build a diversified portfolio. And so it may not be that we think that there's something broken there. It's just maybe there are better opportunities. It's a more conservative position. Certainly some of the steam has come out from the big lift it had in May. So you can certainly look at it here. There might be areas that might be more constructive.
Okay, good to know. Let's move on to Elliot. He's on the line from Hamilton, Ontario. Hi, Elliot.
Good afternoon. When I bought TMX, I top-ticked it at 57, and it's been going down ever since, 11%. Has it blown through your trailing stops? Where is the 50? Is it below the 200? What would you do today with TMX Group? Thank you.
All right, thank you for the question. Mr. Burrows, what would you do?
So, of course, everybody looks at things differently. And for us, again, we look for relative price strength versus the rest of the market. The sector, all of the various exchanges have been backing off over the last 3 months. So within financials, the capital markets banks have been very, very strong, which is where we've been largely focused. We came out of our TMX Group in, I think, partway through July after being there for 3 years. So as it sits right now, it's below the 200-day moving average. It's below the 50, the 21, the 8-day moving average. They're all moving now lower. And relative strength, from a relative strength perspective, 70% of the companies in the S&P have performed better over the last 12 months. So it's just kind of a laggard, and I think maybe there are other opportunities.
Okay, Elliot, I hope that helps you out. Let's move on to John on the line in Toronto. Hi, John.
Hi, Marella. Marella, this is for you. I'm a really big fan of the work you're doing. You're always pressing your guests to get more information for the callers, so thank you.
You're welcome.
Yeah, David, I really look forward when you're on. Always good information. I stayed with Hudbay Minerals from $6 to today, $24. I'm looking for the next winner. Is 4N Mining it? And David, do you own it? Thank you very much, David.
Okay, thank you for the question. So 4N Mining, copper, zinc, gold in Canada. David, do you know them well?
So for folks who watch, we've been focused on talking about materials over the last 2 years. And we are not gold bugs, we are not commodities bugs, but we are fans of finding leadership in the market. And materials are being revalued currently. Certainly commodity prices have been improving, but the multiple investors are prepared to pay is expanding. You see what's happening in the gold producers. The price of the metals moving up so sharply, which means the cash flow margins are expanding and the value of what's in the ground is expanding. We know that there is demand for power everywhere in the world, and you can't have power without copper. There's only so many, producing copper assets, very few new assets coming on. So we own Hudbay. It's been a big position of ours for a long time. We also own some 4N Mining. 4N we like because it's in, a friendly jurisdiction. It has not been the leader in the group. Hudbay has. We also own some Tech B, which we think, the new combination could be quite good. And we look beyond the QB2 problems. But there's a raft of intermediate sized copper producers and small copper producers. This is a couple of $1 billion in size, so it's big enough for almost any institutional investor to purchase. We really like the copper group, and I like 4N.
Okay, John, I hope that helps you make a decision. We're going to move on to Pete, who's calling from BC. Hi, Pete.
Hello, and good day to both of you. Mr. Burrows, I too am a big fan. MDA Space, you were promoting it as a top pick a couple weeks ago or several weeks ago, and then right after that they got hit with the Echo Star News, which was I think a surprise to everybody, and it took a 25% haircut. I was excited when I saw that, and so I picked quite a bit of it up, and I just wanted to know your thoughts today.
Okay, I'm taking a look at the line now, David. So it's at 46.36. That was sort of mid-August. It's down to 36.25 today. Yeah,
look, we're in the early stages of the space economy. I mean, there's no other way around that. And the products that MDA is producing, are going to be in demand for a long time. So yes, the EchoStar news was a surprise because they were, a big part of the backlog. MDA, though, continues to have a very, very large backlog. Stock pulled right back to the 200-day moving average, which is done many times over the last year, and held and rallied off it. So we are owners, and we think that there's no less opportunity here than there was. And so I would be a buyer of the stock here.
Okay, we're going to take a quick break. David Burrows, Barometer Capital Management, taking your questions on North American large cap. Here's how to reach us again. We're back in a moment. Stay tuned. Welcome back to Market Call. We have David Burrows with us. We're going straight to a question from Craig in Kelowna, BC. Hi, Craig.
Good morning. Thanks for taking my call. This question, for context, David, relates to my parents who are in their late 80s. They've owned CGI for many years. I see CGI is down big this year. Their advisor is suggesting to sell it and move into silver, which makes me very nervous. But I see the analyst recommendations for CGI is around 165. So I guess my specific question is, do I avoid that advice? I would be very nervous to chase silver, given its historical levels are between 20 and 30. Or should they just hang on to their CGI and wait for it to come back up close to what the analysts are suggesting?
Okay, thank you. Thank you for the question. David, what do you think?
Okay, so obviously all of these things we always have to take into context for a client, and every client's situation is different. I don't know whether the dollar number that is being managed, to create an income for these folks is safe, or if they're on the line. But I'm just going to take it from a stock perspective. CGI has not been performing well. It was a great company for a very long time. They made a number of very good acquisitions and grew very substantially. I think one of the concerns is the business that they do a lot of business with the U.S. government, and that some of that business could be in question right now. Stock technically is broken. It's trading, broke the 50-day, back when it was at $150 a share. And has been weakening since. All of the moving averages are moving lower. So for us, if we owned it, we would have been stopped out a long time ago. So the question is where to from here. If something isn't rallying in the middle of a bull market, there's generally an issue. And so I would prefer to own a more productive asset. Now, the question is, do we trade to silver? Look, I'm very bullish on silver long term. Somewhere in here, there is going to be some correction in the precious metals. And if you look at the bull market of the 2000s, somewhere in around here, this far stretched above the moving averages, it should correct. If it is a bull market more like the 70s, these stocks could double from here before they correct. So our long-term thesis is we're in a precious metals bull market that's going to go on close to a decade, and we're maybe 18 months in. The question is whether it's a trade from CGI to silver. I would say it's a trade from CGI to something else. And frankly, for us, a seniors couple, I'd be more focused on sort of a dividend grower. And if you want precious metals, you could look at one of the more conservative names like an Agnico, for instance, great cash flow and a nice growing dividend. But I would be gone on the CGI.
Okay, and just to clarify, because they're seniors and they've been invested in this long time, would you take a big chunk out? Would you take all of it out? Would you take half of it out? What would you do at this point?
Look, we don't mess around. If something breaks down technically, we sell it.
Okay.
The most important thing is not to let a little mistake turn into a big one. And this one's probably come down more than you would like to see. It certainly, would be too much for me. We don't have big risk appetite. If you look at the long-term history of the stock, it has had a tendency to hold at the 200-week moving average, which we are now well below. So it's a change in behavior. So I would exit the position and find something maybe more suitable to the current market environment.
Okay, let's move on to Brian then. Brian's calling from Kelowna, BC with his question. Hi, Brian.
Hi. I've been following Mr. Burrows for about 25 years, and I just want to say thank you very much for all your insights. You're definitely the best of the best. And the question I have today is about JP Morgan and Chase. What do you think about that stock?
Okay, thank you for the question. Go ahead.
JP Morgan has been one of our top 10 positions now for 4 years. Here's the way I look at it. First of all, the financial sector has been performing very nicely. It went through a long-term bear market from 2007 to 2021. If you looked at the most simple measure, the XLF ETF, which is U.S. financials broad-based. When a group goes through a 10-year period or a 15-year period without making a new high and then eventually breaks out, it generally means you're at the beginning of a new long-term bull market. What happens in the long-term bull market is that not only do earnings grow, but multiples expand as people become more comfortable. Remember, anybody who wanted to sell it has had an opportunity to make their exit. Now, when we buy a sector, we want to buy the leader in the sector first, the one that is best from an income statement and balance sheet perspective, and the best one technically. JP Morgan broke out to a new high in 2013, so 8 years before the sector broke out. And that tells you what investors think about JP Morgan. So look, I think that we have a long run bull market in financials in front of us. JP Morgan is the absolute leader. We aren't going anywhere anytime soon unless something dramatic changes.
Brian, I hope that is good for you. Let's go to Demerty. He's calling from Markham, Ontario. Hi, what's your question today?
Good morning. My question would be on Sunoco, please, and if there's any comment on the upcoming merger with Parkland. Thank you. Okay,
so Sunoco, of course, an American company taking Parkland after, that's still going through the process, but it did clear a key hurdle just this week from Ottawa. David, what do you think of this deal?
Well, look, Sunoco I'm not a huge fan of. We prefer the Canadian long life assets. So I don't have an opinion on Sunoco because I haven't spent a lot of time on it. So I'll just have to leave it at that.
Okay, we will leave it there. We're going to take a quick break. When we come back, I'll look at David's past picks. That's up next. Stay tuned. Time now for a look at past picks from David, and he joins us on the show. October 2nd, 2024 is what we're looking at. At the time, David, you chose BWX Technologies on the New York Stock Exchange. So they do nuclear components as well as fuel. It was $113.28 US at the time, up to $208.77 today. So an 84% upside and 85% total return. Is this a company you are holding onto at this point?
Yeah, look, we've spent a lot of time over the last year talking about power demand, and we're going to have to expand power production a lot, and that's not a new topic. BWX is a company that has been making small nuclear reactors and running them for the Navy since 1958, so it's a pretty proven technology. They do a lot of work with Ontario Power Generation, and we think that the nuclear sector is one that we want exposure to. So, we've talked a lot about Cameco over the last year, and BWX we brought up a couple times. Look, this is going to be a growth sector for a long time, and I think that investors want to find different ways to participate. You can do it using the URA ETF or the NLR ETF to get a broad base of companies. But this is a sector, I think, that has a long tailwind and multiples are expanding.
Okay, good to know. Let's go to your next past pick, which was Teck Resources. Again, this was October of last year. At the time, it was $70.77. Now it's $61.50, so it is down 13% for return, down 12% total return. And they have announced that December 9th will be the day that their shareholders vote on the Anglo-American offer to merge. First of all, David, what did you think of the offer?
Well, look, I have to be honest. I think that the long-term outlook for Tech B is very, very strong on their own. If they were to merge and get this deal done, I think it probably gets better. It becomes a very important institutional name for investors around the world. I think that the disappointment over the last year was the ramp up in their QB2 mine, and that's part of the reason they're considering this deal. They will get that fixed. So I'd be a buyer of the stock here, and I think ultimately for investors, this is going to be an important copper name.
Okay, let's get to your third pick from last year, which is Uber Technologies in New York. At the time, 74.28. U.S. up to 94.08 today, 27% upside. Total return of 27% as well. What has Uber been doing? Is this a stock that you intend to hold onto longer term?
Look, this is a story of growing cash flow, and it is going to continue to grow. Now, the analyst estimates for this upcoming year have been mixed. There have been some upgrades and some downgrades. The long run story is intact. As a firm, we have reduced our exposure to the consumer in general. The stock is behaving very well. It's been a strong performer. So I'd have no problem purchasing it, but we're focused in some other areas right now.
Okay, let me just interrupt. Why are you focusing away from consumers? What's your theory around that?
Well, a couple of things. First of all, I think that inflation is stickier than the market is picking up on. I think there are clues to that. Things that do well in an inflation-oriented environment are what's leading the market. So I think that can have an impact on the consumer. I think that the jobs data in the U.S. is weakening. And if you are a consumer who has assets, the world we're living in right now is great. If you're a consumer who is living month to month on your wages, life is getting more expensive, and wages are not keeping up. So in general, when I look at the consumer sector, the breadth of the advance or the percent of stocks in the consumer sector that are performing well has been weakening steadily. And so that tells me that there isn't enough new money going into the group, or there's enough money coming out where your risk reward is really not in your favor. So obviously there are going to be better companies and worse, and Uber's one of the better ones. But I think that you could look at the gig stocks and look at Amazon, for instance. Amazon has had weakening relative strength now since January of this year, and is just hovering above the 200-day moving average. I think that's a pretty good indicator of the consumer.
All right, we have to take a quick break. David Burrows, Barometer Capital Management, taking your questions today on North American large caps. We'll line up the phone calls for when we come back. Stay tuned. Welcome back. David Burrows with us today to take your questions. We'll go to Chris in Hamilton, Ontario with his question right now. Hi, Chris.
Oh, good afternoon. Thank you for taking my call, and thank you for David and all his wise advice. Anyway, I just wondered what his view was on Whitecap, and if he held it, which I do, would he continue to hold it? I'm a couple of dollars underwater, but it pays a good dividend, so I've been sort of hanging on, hoping that the oil sector would buck up a bit. Anyway.
Thanks for that question, Chris. David, a lot of the oil stocks we know have not done so well this year. What's your forward look on oil, and what do you think about Whitecap specifically?
Sure. So, Marilla, obviously there's been lots of cross currents in the energy market. We've got a president south of the border encouraging drill, which likely means some supply. We've got things going on in the Middle East, maybe some pressure coming off geopolitically there. And so the price of oil's moved a little bit lower. we're just coming out of the seasonally weakest period of the year. And frankly, I have to be honest, I think that the large cap energy companies have traded better than you might expect they would, given where oil is. So, the big ones have been outperforming. Now, in the case of Whitecap, stock bottomed around $7 and has been working its way higher in a series of higher highs and higher lows. Stock's in an uptrend, is trading above a rising 200-day and 50-day moving average. So technically, it looks just fine. It's certainly not broken. And this is a name that lots of people like. We've focused a little bit more on the Clearwater ourselves. Companies like Tamarack Valley, which performing a little bit better in the market. It's a different type of company, and the estimates are getting a little bit better there because their water flood technology is working well. But if I own Whitecap here, I'd be a holder. We're coming into winter, and seasonally things get better from here.
Okay, let's move on to Rob then, who's calling us from Houston, Texas today. Hi, Rob.
Good afternoon. A quick question, keeping with the Canadian oil section, is his thoughts on Canadian natural resources, please.
Okay, so CNQ, pretty steady bet for most, I think, but because of the situation with oil and energy, as you mentioned, David, would you trim at any point for CNQ?
Look, I own a lot of CNQ personally. We own it as a firm. Certainly it has been testing investors' patience. A couple of things that I think could be relevant longer term. They do have quite a lot of natural gas. The situation for liquefied natural gas in Canada is getting a little bit better. It's been performing in line with the S&P, to give you a sense, and it's trading sort of in and around support. So it's not been the strongest performer. I think ultimately, whether you're looking at Imperial or whether you're looking at CNQ or whether you're looking at Suncor, the long life assets are really, really attractive. The yield is attractive and the dividend is going to grow over time. So this is one that I would give a little bit of birth to, and I would be accumulating it here in the lead up into a seasonally stronger period.
Okay, good to know. Let's go to Sandy on the line in Toronto with her question. Hi, Sandy. Sandy, are you there? Okay, may have lost her. I think she had a question on Pembina Pipeline. David, can you speak to that?
Yeah, so I have to say we have been cautious on the pipes. In general, whether you look at the AMLP ETF in the US, which is master limited partnerships and mostly pipelines, it's hitting relative strength new lows for the year. A lot of the pipes in Canada are hitting relative strength new lows for the year, including the best performing one, which is Enbridge. And we own Enbridge. The price chart looks fine. The relative strength is weak. So for the yield, I think that they're fine. I think that the people who are looking at long life, sort of more utility-like assets are focusing more on electrical power generation. So in that camp, you might look at like a Capital Power, CPX. So right now, we just don't have a lot of pipes exposure. For our energy exposure, we do prefer where we think that there's more upside in the long life producers.
All right, let's move from Sandy to Jacob, who is in Toronto with his question today. Hi, Jacob.
Hey, hi, good afternoon to you. I'd like to ask your guest, please, about Shopify, if I should buy it or not. I'm tempted to buy it. I don't know about the prices, but the earning is so high, so I'm a little bit apprehensive about it. What does he think about buying it or what else? Thank you very much and have a great afternoon.
Thank you, Jacob. David, Shopify tends to bounce around quite a bit. It's at 222 right now, up a little bit on the day, 96% up over the last year. But do you put money in Shopify, and why does it bounce around so much?
Look, it's a high price stock. The fact is it does move around. It's a big piece of our Canadian index. It's an important stock for institutional investors. We don't have anything else like it in Canada, so it's going to get lots of attention. Relative strength has been improving for the last, 18 months, and trading better than 91% of companies in the S&P. The earnings have been, in general, being revised higher. The estimates being revised higher. Certainly more being revised higher than lower. So we're coming up on the old highs from 2021. That may be a little bit of technical resistance. But if you're looking for growth stocks, this is a growth stock. We tend to be leaning more towards cyclical companies right now, given the choice. But there's certainly nothing that I can say about Shopify that would tell me it's not worth owning.
Jacob, I hope that helps or give you some direction on making a decision about Shopify. We'll go to an email from Bill. He says, "Hi, David. Can I get your opinion on Banco Santander?" Banco Santander, do you know well, David?
Yeah, this is a company that we've used as a top pick, actually, over the last year. As we've talked about, we pretty consistently over the last 3 years like the financials. And over the last 18 months have been very focused on international companies. Banco Santander is really the largest bank outside the U.S., $155 billion market cap. We think that it is as good a bank as any bank in the world, but it trades at just under 10 times earnings versus, say, Morgan Stanley at 17 times earnings. Got great exposure through South America and Europe. They've got a very strong digital platform, and they've got a good, strong capital markets, commercial banking business. In the consumer, they've got a growing consumer base. So we think this is a great purchase. At these prices, we bought it and have been buying it pretty steadily over the last 8 or 9 months.
All right, let's take a quick break. We're going to be back for our last segment with David Burrows taking your questions. David's with Barometer Capital Management, taking your questions on North American large caps. Back in a moment. Welcome back. Let's go to the phone lines. Tudor is on the line in Calgary with his question today for David. Hi, Tudor.
Hi, thank you very much for taking my call. David, my call is on Imperial Oil, and I know you like the stock. I've noticed, actually, it's been going down fairly steadily since the announcement of the layoffs and restructuring, and I'm thinking of putting in a stop loss on it, and I wouldn't mind your thoughts on a stop loss around 118.
Okay, thank you for the question. Imperial Oil sitting today at 119.22, so it's up a little bit on the day off its high, though. David, what do you think?
Look, Imperial has not been on its own pulling back over the last couple of weeks as oil prices have been weakening. I think that the weakness has a lot less to do with restructuring than it does just with weak oil prices. Imperial has been the leader over the course of the year in the large caps, and continues to be. So they're going through restructuring. They're obviously looking at some cost savings, and it's difficult because a lot of people lost their jobs in Calgary, and for many others, they've been told they keep their jobs if they want to move to Edmonton. So I'm certain that some of those folks will opt not to do that. So tricky for those people, but long run, this is just a great asset. They are getting to the point where they've, brought their balance sheet into line where they want it. And with oil where it is now, I wouldn't expect a near-term dividend increase, but I think that if oil prices stabilize and move a little higher, you're likely to continue to see great dividend growth. This company's grown its dividend, over 20% a year over the last 5 years. And so I'd be a buyer of the stock. Now, from a stop loss perspective, there's a couple of places you could do it. I think that the logical point at this point would be kind of like 114. You could use 118. It's an awful near-term stop, and that's the most recent low. So I can see why you would look at that. I would give this a little bit more berth given just the time of year and the structural long-term chart for Imperial, I think, is very bullish. So I would give this a little bit of space. But certainly it's nothing outside of what's been happening in Suncor or CNQ or frankly, U.S. oil companies. If I could just say this, these big Canadian oil companies are very different than the oil companies we're looking at in the U.S. that are, producing shale oil. The reserve life should be worth a lot more, and these should be trading at a significant premium. Imperial does trade at a premium to the group, but it's well deserved.
Okay, let's get to Ghulam, who's calling from Toronto. Hi, Ghulam.
Hi there. Good afternoon. My question is on TELUS. For the dividend, and do you see, is the dividend safe? And you expect any capital appreciation in the next, I think it's almost at a 52-week low right now. So is it a good buy at this current price? I'd appreciate your opinion. Thank you.
Okay, thank you for that question. Telecommunications has been not doing overly well. They've been struggling to find new sources of revenue. What do you think of the space? What do you think of TELUS?
Look, everybody has a different approach to things. Our approach is we buy market leaders and we buy sectors that, are being positively revalued. In other words, where investors are prepared to pay a higher and higher multiple of earnings. This is a sector where the multiple has been contracting for a long time. Money's been moving away. And, that is the $64,000 question. Where does revenue come from? So it's just a stock I would not be a buyer of. I think that it's very hard to turn around a stock that's in a very weak sector that's underperforming. There's a lot of people at higher price levels that just love to have their money back. So you got built-in sellers. If you can't rally in a bull market, what happens in a bear market? Probably gets worse.
Okay, Ghulam, I hope that helps you. We're going to go to Debbie from Burnaby, BC with a question. Hi, Debbie.
Hi, good morning. I'm just wondering about copper stocks. I don't have any. I was thinking maybe of Lund, Lundgin. But if you could give me some suggestions, I would love to hear your opinion. Thank you. I'll hang up and listen.
Okay,
Thanks.
so that's Lundin Mining Debbie's talking about. Do you like Lundin? Are there others in the space she should consider?
It really depends, Debbie, on what you're looking for. So on one hand, we think that the big copper producers are going to be big cash flow generators and generate dividend growth and special dividends. So if I were looking for one name from that perspective, you could look at a tech beat because it is going to be an important stock for a long time. Now, others, when you get into resource cycle, want to look for smaller, intermediate-sized companies that ultimately might get purchased by a senior. And, certainly Lundin fits in that camp and Hudbay fits in that camp. You have to be prepared in resources for inevitable pullbacks. They will happen. And so you have to figure out what volatility you can live with. We've been sort of on this train now over the last year, and they've rallied a lot. I think that they've got a long way to go, but there are going to be pullbacks along the way. You just have to be ready to stomach that. If you're looking just for a large cap name that you could own for a long time and will ultimately wind up being, I think, a very strong dividend growth stock, combination of tech and Anglo would, I think, be quite good.
Okay, good to know. Let's get to our last caller for the day is Richard. He's calling from Quebec. Hi, Richard.
Hi, good afternoon. Market Call is a great show, and David, you're a top gun. I would like to have your opinion on Celestica, the hurricane. Thank you.
Okay, thank you for the question. Let's have a look at Celestica. We'll pull up that chart. It's at 396 on the TSX. David, what are your thoughts?
Yeah, Celestica is a big holding of ours. This has been a great performer, and for good reason. They are in the right spot. They are certainly benefiting from data center build out. They're benefiting from automation. They're benefiting in healthcare. It's a really strong company operationally, and we think that it is going to be an important stock in the Canadian market for a long time. So we'd be a buyer of the stock here, even though it's up a bunch.
Okay, we are going to take another quick break, but we do have some new top picks from David. He will share those when we come back. Join us tomorrow on Market Call. Ryan Bushell will be with us on the show. He's president and portfolio manager, New Haven Asset Management. He'll take your questions on Canadian dividend stocks. And if you miss an episode of Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from David Burrows of Barometer. We're going to start with Agnico Eagle, AEM, on the TSX, a very well-known company. David, why do you like Agnico Eagle moving forward?
Morella, we see it as our job as portfolio managers to recognize structural shifts. And almost 2 years ago, when we started putting on gold positions, I have to be honest, we were really almost apologizing to clients for talking about gold because it was such an unpopular topic. I think today, 40% of investors have a 0% weight in precious metals, and the average portfolio manager has 2%. When a bull market starts in this area, it can go on for a decade, and there will be multiple stages, and we're probably in the first one. So we can correct at any time. So you want to make sure that you own companies that are the leading companies, because mining is a really hard business. It's really easy to make mistakes. It's really easy to be disappointed. And Agnico's management team for years and years and years has just done a great job of doing what they say they're going to do. So why we like Agnico, there's a lot of people who don't own any gold. This is a great single name for somebody to own, is that they have multiple properties, all in geopolitically safe jurisdictions. They have long reserve life. They have been very, very good at managing their costs. Now, with the price of gold going up, it covers a lot of mistakes. At $34.60 per ounce, they're going to make a ton of cash. Sequentially, they probably have a 50% year-over-year cash flow growth quarter, and I'm going to guess it'll come in better than that. They probably generate, around $1 billion in free cash flow. Their balance sheet is in great shape, and you can expect they will continue to increase what they return to shareholders by way of share buybacks and dividend growth. So we just think this is likely something that will be in our portfolio for a long time.
Very quick question. How key is jurisdiction to these mining companies?
Well, we know that historically when some governments see companies start to make a lot of money, they say, oh, look, this is a windfall. We want a piece of it. And so having good rule of law and protection of assets, we think is really important. We don't like to wake up to a surprise where a mine has been nationalized or where there's been a large levy imposed as a tax.
Okay, let's get to your next topic, which is Caterpillar, CAT, on the New York Stock Exchange. You're looking at something very specific under the umbrella of Caterpillar, and that is their solar turbine business. Tell me about that.
Yeah, well, look, first of all, I mean, if you think there's a mining cycle, Caterpillar is going to sell a lot of equipment. That's a given. And as companies raise more and more capital, they're going to spend more money on doing development work. Caterpillar is going to do a lot of business there. That's a given. The thing I think people are underappreciating in Caterpillar is they have a big turbine business. They're called solar turbines. They have nothing to do with the word solar, but they make natural gas turbine generators that are smaller than utility grade generators that say GEV or Siemens might make, but big, like 100 megawatts. And this business is going to be a big business as we're seeing these data centers get built out. They're looking for alternate and backup sources of power, and Caterpillar has a great opportunity to grow here. It's only 5% of revenue right now, but this could grow at kind of 25% a year over the next number of years, and the pricing is going to be very strong. So Caterpillar has a lot of engines for growth. Their service business is great, but the combination, I think, is set to accelerate.
Okay, let's get to your last pick, which is Cameco, which will benefit from the demand for energy, but it might take longer to get there.
Yeah, it's going to take longer to get there, but look, pricing for uranium is certainly moving higher. Cameco made great acquisition from Westinghouse when they bought a lot of Westinghouse nuclear capacity, capabilities. So again, go with the leader. This was the first of the uranium companies to break out to new highs. This is going back a couple of years ago. It's got a giant structural base. In the last bull market in the 2000s, it went up about 1,000%. And we think that there's both pricing power in uranium and volume growth. So again, this is a portfolio holding. It's not a speculative position. And it's one that I think is really going to benefit the environment that we're going to be in for the next few years.
All right, we do have to leave it there. David Burrows, thank you for joining us, sir. We'll see you again soon.
Marilla, thanks for having me.
And thank you for joining us today on Market Call. We'll see you again tomorrow.